Good morning, Jags. This is Fahad. Today is Monday, February 1st. Let's get started. Um, hey, Jay and Chronicle, have you heard of this company called Avino Silver and Gold Mine, symbol ASM?
I have not.
Nope.
So, last week on Thursday, when we started to see massive amount of call option activity in silver across the board everywhere, that's when I sent out this note, this trade idea. And I said, do you feel like gambling? This was on January 28th at 11 o'clock in the morning. And there is this tiny little company, a silver miner, which is about $350 million in market capitalization, called McEwen Mining, MUX. So we all bought MUX common stock for $1.12. That's it, $1.12. So these are not call option. This is common stock position for $1.12 or less. And I bought this mainly because we had that massive amount of call option activity that was picking up, and on top of it, mainly driven by WSP crowd. But then also MUX, which is a chart right here, has 17% short interest, so it made sense. This morning, this stock is sharply ripping higher. We bought it at $1.12. It's trading at $1.58. So the position is now up 40% in just 3 days. But I bring up ASM, Avino Silver and Gold Mines, because at exactly the same time when I was thinking about buying MUX, I was also looking at ASM. The problem with this was that ASM only has 1% short interest. So, I looked at this and I said, okay, if the silver is going to sharply rip higher, we're going to see the benefit of this sharp rally in both of these stocks. And they were both trading, both of these companies, ASM and MUX, were trading at exactly the same price, about $1.10 at the time. Well, looks like that ASM, despite having only 1% short interest, this thing is gapping higher by more than 110%. It closed on Friday at $1.23. It's trading at $2.75 in pre-market. So it's up. I don't know, you can do the math, probably what, like 130%, 140% or something like that in pre-market. So went with the wrong horse, but it's still, I cannot argue with the 40% gain. On the other hand, if I had gone with ASM, we would have a much, much nicer gain this morning, but that stock only has 1% short interest. So interesting to see this thing is spiking higher. Nevertheless, on a quick note, I'll probably be taking profits on MUX this morning. I'll just close the position, book the 40% gain, and step aside. The reason for that is I believe that this and the bounce in the S&P futures this morning is also potentially highlighting this. I'm of this view that this short squeeze mania that ended up hurting a lot of hedge funds, I think this is starting to get a little too overblown. You see, once the playbook is learned, then playbook is over. And right now, everybody has figured out what the playbook is, which is that you basically find the stocks that have the highest amount of short interest and you just go long without any kind of fundamental basis to it or not. So as a result, there's a lot of price action in the market, which is starting to just appear everywhere. And I think that with the amount of coverage, the coverage that Wall Street Bets is getting right now, if you look around, Bloomberg is covering it every hour, 2 hours. Wall Street Journal is covering it every hour or so. CNBC, it's a nonstop discussion on live networks, both Bloomberg and CNBC right now. Every journal, every newspaper, Twitter cannot get enough of it. I think the short squeeze mania is coming to an end already. In fact, we may actually see the peak of it today. And from there, nobody will care about whatever the Wall Street Bets are doing. So as a result, I don't have any intention to continue to stay in this stock, MUX, which was a pure trade with the silver miner running. I'll probably just take profits and step aside. Now, with that said, I do have one stock that I would like to discuss first time ever, which is this biotech called IGM Biosciences. Now, we only covered this one time in JAG history, which was back in November. Modestly, it was a brief note, nothing significant, but one to keep an eye on because this is a catalyst driven stock with some very important data that's coming out by mid 2021 in the summer. If you notice, this $95 biotech. It's about $3 billion in market capitalization. We had a massive high volume spike for 3 consecutive days in early December and a huge breakout at the time. And the stock has since settled back in and is starting to show some improving relative strength since the beginning of the year. Two things I would like to point out. One, on the actual sentiment and the technical side. Goldman Sachs had a note out, an interesting note out last week, in which they mentioned that they're seeing improving relative strength for the entire biotech sector. Whether you compare XBI or IBB to the rest of the market, whether you're comparing it to the value themes or the growth stocks within the information technology sector, you'll find out that biotechs in general have been performing far better since the year started. So they believe there is new positioning that is taking place by hedge fund communities to look for outperformance in this group. And since we're still in the early part of the year, I think this positioning will likely continue for the rest of the year and could have some significant upside. So keep an eye on XBI, for example. You can see that even when the market was selling off, XBI held up very, very strong. On a percentage basis, since the start of the year, XBI is up approximately 8% since the start of the year versus S&P is down 2%. So that is 1,000 basis points of outperformance by biotech sector. And so that's an area to focus, and I think there are opportunities here. So that's the first thing. And the second thing is this company, IGMS, is engaged in development and engineering of IgM antibodies for the treatment of cancer patients. This is an area or the segment of the whole biotech chain where there's a lot of research taking place, but there are no breakthrough drugs that are actually in the market because cancer is very, very hard to crack. This company has developed IgM antibody technology platform that is particularly well suited for developing T-cell engagers, receptor cross-linking agonists, and targeted cytokines. So, if you notice what happened over here back in early December was this company reported some preliminary data, and according to this data, let me just read something over here. This was a phase 1 data evaluating a drug called IGM 2323, which is a bispecific IgM antibody targeting various receptors, and the data was presented at the 62nd American Society of Hematology meeting, and the data included 14 patients that were given different kinds of dose sizes, and 9 of those patients showed evidence of tumor size reductions, and 2 patients showed partial responses, including a patient with follicular lymphoma and a patient with diffuse large B-cell lymphoma. The entire readout of these 14 patients was actually seen as quite promising that we had originally thought. And as a result, you saw this stock actually take off sharply. Now, with that background, last week there was an initiation note from RBC Capital in which they point out, I quote over here a long paragraph, early signals suggest IgM 2323 drug could be tracking towards best-in-class potential among NHL biologics and provide initial validation of IgM platform. 2323 IgM's lead antibody is an IgM-based CD20 CD3 bispecific in non-Hodgkin's lymphoma that, consistent with preclinical clinical data demonstrating low cytokine release and high T-cell complement mediated cell killing, has shown low rates, severity of CRS, a major tox limiter for other T-cell engaging malignancy agents. Though the phase 1 is still dose escalating, promising activity has already been observed with responses in 2/3 of the patients. And then they go on to say that further follow-through data of this drug will be presented sometime in mid-2021. And they believe that this company is, I quote once again, far ahead of competitors. If if the promise plays out, they see $1 billion in annual revenue opportunity in out years. So there you go. $3 billion market capitalization for a name like this is actually rather low for somebody that is becoming a leader in creating these antibodies to treat cancer patients. If they announce a strong phase 1 data sometime in the summer of 2021 and then move on to do phase 2 accordingly, I expect this thing to gradually grind higher to 120 to 130, maybe even higher, depending how that data comes out. And I don't have a specific date yet. One last thing I will mention, this company already did a large secondary share offering. There is always a risk with development phase biotech companies. They did a $600 million $200 million common stock offering at $90 per share. That was on December 8th, right after this data came out. That's when the stock actually fizzled a little bit, but they should not have to do any more capital raises because based on their recent balance sheet announcement, they have $366 million capital on hand, which should be good to last all the way up until the phase 2 data is over, which is going to be another year from now. So keep an eye on this one. I will keep an eye on any kind of pickup in option activity, although I usually don't see any. I think this stock is going to break out from this bull flag and make a run towards new 52-week high. That's it from me. Let's go to Jay.
Morning, everyone. On my watch list today is KBR Incorporated, symbol KBR. This is a government services provider where 80% of its customer base is in the government vertical. The other 20% make up commercial customers. Now, if we look at the technicals, we can see that back in November, stock finally broke out, had a nice run, but has since retreated. If we use the, what was once resistance now becomes support, we could say that the 27 level could possibly be a good entry point. Fundamentally, I really want to focus on the space segment for this company. If we go back to their last earnings call, here's some commentary from the CEO where they talk about their space and mission solutions segment. The growth in this segment year over year has absolutely been terrific. We've seen attractive on-contract growth as existing programs performed well across both NASA and the Department of Defense. We continue to win contracts to perform high-end IT and data analytics solutions. Space and Mission Solutions is about a $1 billion revenue business, and thus having a backlog of $2.3 billion sets us up well for the next few years. From a market outlook perspective, much like we saw in the cyber domain, we continue to see greater collaboration across space. Our position within NASA and our presence via Centauri, which was acquired back in August, and military space and intelligence aligns well. Last week, Truist was out with a note where they took a look at a bunch of names within the government services industry, and they say that KBR, Science Applications, SAIC, and Parsons, PSN, are the most levered to space initiatives. But KBR carries the highest aggregate exposure to space programs with a long history as a leading NASA partner. The recent acquisition of Centauri should bring a stronger presence in the DoD intel space programs, as well as expertise in space domain awareness. They go on to say, as the space domain emerges as a critical national security priority, they anticipate further integration of DoD, NASA, and intel space programs. So overall, you want to keep an eye on this space segment going forward. A couple other quick notes. This Wednesday, Citigroup is hosting a fireside chat with the topic being a deep dive into the company's new technology solutions business. Credit Suisse was out back on January 22nd saying that this business is being underappreciated as it is a high margin business that will play a role in the transition to a carbon neutral economy. And then finally, in a best ideas note from January 15th from Truist, they do mention that there is a possibility for an investor day sometime in March where the company might lay out a new multi-year set of financial goals. But right now, just keep an eye on this space and mission solutions segment for the company.
Very interesting type of stock that I rarely look at. But now you bring it up. Purely from a technical standpoint, I would wait for an entry either, as you said, down at 27 level where the major support comes in, or I would wait for a clean breakout through $30 per share, which will then open the door for a new leg higher that could carry the stock all the way to 33 to 34. So those are the level. Either wait for 27 or wait for a move above 30. And then also, I will point out that this is another, as you were talking, I was just looking at the trend of revenue growth for the last several quarters, and this company is similar to many other cyclical names that went from reporting a negative growth middle of last year to slightly positive, and then finishing the entire 9 months of 2020 up 3%. But now, if you look at the 9 months of the last year, it's up 3%. But if you look at a single quarter, which was Q3, it was up 13%. And so clearly sequential acceleration that took place throughout as we came out of the pandemic, and potential major beneficiary of the world moving into carbon-less economy. So one to watch. Good stuff. All right, let's go to Chronicle.
Good morning. I have two items today, and coincidentally, they're both related to ETFs. So first thing is, I just wanted to bring it to attention that with the short squeezes going on, which in turn has forced institutional portfolio managers to partially liquidate some of their long positions, I wanted to point out one ETF that we might want to be watching, which is called the Goldman Sachs Hedge Industry VIP. Ticker for that is GVIP. I wanted to bring this up because this ETF essentially tracks the most concentrated long holdings of hedge funds. It's basically a representation of a hedge fund hotel, if you like. And if we look at the top holdings of this ETF, it looks like a lot of hedge funds are currently long some of our favorite names at Jaguar, like for example, Mercado Libre, PayPal, Sea Limited, Carvana, Peloton, and even Micron. So there's no doubt these are great companies, but if we get a continuation of what we saw last week, then I would not be surprised if they continue to get unwound in the near term. So I guess the point here is keep a close eye on these stocks, and if anyone's currently long any of these names, I don't think there's any reason to panic, but it's something to be mindful about as we start the week. And I think once the short squeezes start to fade away from the headlines, there's going to be yet another buying opportunity in these stocks. So that's the first item I wanted to talk about.
Sounds good. Yeah. There's several actually other ways of tracking the top U.S. Hedge fund holdings as well. The only problem, and is this that what I don't know is I think that a lot of these filings in the SEC filing of these ETFs is really based off the last reporting date from these hedge funds, which was really, middle of October 15, which is usually basically 45 days after the quarter is ended. So as of the September 30th holding were basically filed with the SEC on October 15th, or right about that. And so a lot of the ETFs holdings that we see is based off of that. But since then, so much has changed. Just in the last 2-3 weeks, so much has changed. That's why it's difficult to see what the composition is. We're going to get plethora of new filings basically around 2 weeks from now, middle of February. But even then, I'm not sure exactly how much we're going to learn, because that will be for the year end December 31st. And again, so much has changed in the past 2 to 3 weeks. But I agree with the direction over here that if the momentum continues to fade in NASDAQ, these are the names where they may actually go after as winners become areas of source of funds.
Second thing I wanted to mention is that I'll be looking to take profits in the Van Eck Rare Earth Metals ETF, ticker REMX. I first talked about this on November 24th, and I'm currently up more than 200% in my call options, and I'm looking to exit for a couple reasons here. First off, I think the thesis regarding China tightening its controls over rare earth exports is getting very close to playing itself out now, at a time when the Biden administration has already started looking into other sources. Recently, like a couple of weeks ago, China put out a report saying that they've reduced exports of rare earths last year by 23.5%, And from both a pricing and geopolitical perspective, I don't think it's going to get any worse than that as we begin this year. And I also think that sooner or later, the market's going to figure out that China's tightening of the market is actually not a good thing for several of the biggest constituents in this ETF. While at the same time, the biggest beneficiaries are actually the smaller and newer players that are not in this ETF. And then another reason I'm exiting is because 3 of the larger constituents based in Asia Pacific, they recently did some offerings following this substantial rise in their share prices. So my thinking is that several other companies are likely to follow suit, which is obviously not going to be good for this ETF. Lastly, final reason is that some of the lithium players that are within this index are currently trading at very euphoric levels. And I think there's going to be a material pullback in these stocks sooner or later, which again is going to be a headwind for this overall basket. So putting all these reasons together, I think it's prudent to be taking profits here.
Very interesting. So just a reminder to everybody that back on November 24th, right over here in the conversations video that morning, that's when the bull case was presented in getting long rare earth metal ETF REMX. This has been a phenomenal run since then. And the timing of it was impeccable because that discussion happened about a month after Trump had signed an executive order about rare earth metals. I won't go into the detail of exactly what that executive order was, but that's what charged this rally. And an ETF essentially doubled in the matter of just 3 months following that executive order. We have to watch this very carefully because the political developments around this are always changing, as Chronicle just mentioned, and may have already been played out now in the chart. But the important thing is that when it comes to the U.S., rare earth metals, more than 80% of the entire rare earth stuff essentially that goes into the production, into the manufactured goods in the United States actually is sourced from China. And I believe this industry will gradually shift more and more towards doing this in-house. So there's going to be local, domestic, US-based beneficiary of this trend. After Trump executive order was signed last October, we need to identify what those beneficiaries will be that are locally US based. And I think that's where the best opportunities will come from, not the ones that are focused on the Chinese side going forward from here. Just my personal high level view, but we can dig into that discussion more in the future. All right, good stuff. Let's stop over here. Thank you everybody for joining. We'll see you in the chat room shortly.